Welcome to the Idea to Value podcast, where in every episode we highlight the latest insights into creativity and innovation from experts around the world. I'm your host, Nick Skillicorn. I care about the evidence behind what makes ideas happen, and I've already helped thousands of people just like you through my unique insights into recent scientific findings of how creativity works. I also show you how to turbocharge innovation programs so they finally deliver on the value and ideas you've been struggling to execute. Get your free training on how creativity can be improved by registering now at www.ideatovalue.com. Now let's get on with today's episode. Hello everyone, and welcome to another episode of the Idea to Value podcast. I'm Nick Skillicorn, and I'm thrilled to have with me today Dan Toma. Dan is the co-author of The Corporate Startup and founder of Outcome, and we're going to be talking about the world's most exciting topic today, accounting, specifically innovation accounting. Dan, it's wonderful having you here.
Thank you very much for having me here on the podcast. I never thought that accounting and innovation accounting would reach the status of the most popular topic in the innovation space, or in any space, to be honest.
I mean, it's a big topic with a lot of misunderstandings and a lot of sort of areas where a bit of insight and knowledge can really help. But before we get into that, just a little bit about yourself. Can you just let us know a bit about your own journey, where you came from, and where you got to what you're doing now?
Sure. My background is actually in entrepreneurship, so not far from innovation, pretty far from corporate innovation, I would say. I started off by moving things and breaking things. I've started my own company, which failed, right? Miserably, I would say, but I've learned a lot, and then that set me on a path to do another company, another one after that. Some of them were more successful than others, and at one point, more by chance than by design, I was headhunted by a large telecommunication company in Europe. They said that, oh yeah, this startup thing is interesting. We want to kind of like do the same thing, revamp our product development process. And I joined them. And after exactly 3 weeks, I went to my boss, say, hey guys, maybe, it's just like, this is a great company and everything, but I want to quit because the way you guys are doing product development in this company is just backwards. And not backwards meaning an old way of doing things, just backwards, like literally backwards. The things that we were doing in the startup world at step 1, they were doing at step 10. And the thing that we were doing at step 10, they are doing at step 1. And then he replied, yeah, I mean, you can obviously hand on your resignation today, and thank you very much. But I hired you exactly to do this thing, and exactly to change the company. So I ended up staying quite a few years with that large corporation. And then in the process, I wrote the Corporate Startup. Basically, together with my co-authors, we documented our journey of transforming large organizations. Now I'm a consultant of a very small consultancy company out of London, and we work with large organizations, helping them transform. So if you want a lab, if you just want a workshop, we are probably not the right people, because we believe that innovation is a team effort, and it's a holistic thing that companies need to do. So not a singular intervention, but basically you need to change everything in your company in order to be successful.
And one of those things that you need to do differently is to figure out how you measure success. And that's where this
100%.
concept of innovation accounting comes from. Could you just let us know a bit about your insights around innovation accounting and what companies usually get wrong about it?
Sure. Yes. So let's put it this way. Accounting in general is overrated, right? Especially in volatile environments, you cannot rely on accounting to tell you what to do next, because accounting is at the moment, nothing against accounting, we still need it, right? But accounting in itself is basically giving you information about the past, nothing about the future. So it's like if you're going to use standard accounting in order to steer your company, it's basically like driving your car on a highway going 130, 150, 200, but only looking at the rear view mirror. So you're going straight, but the only piece of information you have about the road is the one in the rear view mirror. I wouldn't like to be a passenger in that car. And I don't want to be a passenger in any car or any organization that is just using historical data to predict the future. Right. So I think innovation accounting is a complementary system to the existing accounting system. It's going to help companies better understand how they are doing innovation-wise. It's going to help investors, employees, and executives better understand how good or how bad their company is doing. And it's going to help product teams and managers understand if that particular product or that particular business model, that particular idea is on the right track to becoming a sounding success in the future.
And what sort of accounting principles are you referring to when you say people are just looking in the rearview mirror?
So basically, we've identified in our research, I would say, if I remember correctly, about 3 conundrums of innovation of standard accounting, right? That to us, at least, they don't make much sense, or they don't make much sense in today's world. First of all, is that the most valuable assets of a company are not accounting recognized assets. And here I'm looking at brand, I'm looking at culture, I'm looking at certain processes, and I'm looking obviously at people. All of these things, they don't have a place in the current accounting system. There is no way you can go to Zappos and say, hey guys, you have a great culture. Show me where can I find that in the accounting books. However, they are successful because of the culture, right? They are successful because of the culture, which is very customer centric. A lot of companies have great innovation processes, right? A lot of companies I worked with, and a lot of companies everybody knows, like for example Adobe, right? They have a great innovation process. However, there is no place in the books for that particular entry, right? Process value X. People are a great asset, but most of the time we use just the mantra, right? People are our greatest asset. However, if you look in the accounting book, you're going to realize that people are under liability. Why? Because people equal cost. The more cost you have, the more liability you have. So you can't say that something is an asset when you treat it like a liability. And you treat it like a liability because in downturns, like the one we're experiencing now, the first thing they do, they cut costs. Where do they cut costs? They cut costs on salary, they cut costs on training, they cut costs on all these things that have to do with the human resource. So again, I think one of the biggest problems with the current accounting system is that most valuable assets of a company are not accounting recognized. The second one we've identified is that accounting-based financial reports show only a final outcome of a particular asset being deployed or used, revenue and earning. However, if you want to understand more about how you can improve that end outcome, you need to understand the process. And the accounting system is not telling you anything about the process. How were you able to convert a plane, a ship, or a plant into X billion dollars last year? It's only telling you that you got X amount of input in raw material, Y amount of output in certain goods that you have produced, right? And again, in the middle is just a black box. And for innovation, that black box is even darker than for let's say the core business, because there's a lot of changes and there is a lot of friction that lead to the company's or to an idea's success later on. But the accounting system is just looking at what have we put into innovation last year, how much have we gotten out, not at the process that's happening inside. However, as a manager, you want more of the process. You want more of the process. You cannot influence outcomes. This is a thing that executives don't understand. They cannot influence a certain outcome of a process. They can only influence the process itself. That influence will result in the larger outcome, but they cannot influence the outcome directly. You cannot go as a manager and say, okay, we want to grow from 10 billion to 15 billion. Right? You cannot do that unless you have a very clear understanding of the process of converting assets into revenue or profit, and then double down on the things in the process that work. That's the second one. And the last one we identified is that the accounting system can't measure something that hasn't happened. And this is particularly important for innovation, right? Because anybody that's done any product, right? Any product, successful or not, they know that probably on an everyday basis, you're at the fork road. You can take A or you can take option B, right? And you're going to use evidence. Some people use more evidence than others in order to choose one option over the other, right? The accounting system is not going to be able to tell us what would have happened if you would have ended up in the wrong place. how much would that have costed the company if you would have taken the wrong decision 3 iterations behind? And that's very important, right? You can say, oh yeah, but that's historical data. Yes, it is historical data, but that's going to show you how good the capability in your company is, how good the people are trained to take those decisions, how good they are when using a certain process, how good the entire ecosystem performs. Accounting at the moment doesn't show that. Innovation accountant should ideally complement this shortcoming and should be able to provide information to all 3 points I just made above.
I mean, all 3 of those are very pertinent, especially the last one, because one thing throughout all of my years, especially when I was doing consultancies with really some of the largest companies in the world, when they wanted to know about how to improve their innovation investments, one of the first questions they'd always ask is, okay, what's going to be the return on investment of this? And return on investment is, for those of you who don't know, it's the amount you get out at the end compared to what you spent on it. What's your view on this concept of return on investment when you're at the start of an innovation project?
It's just wrong. It's just purely wrong. At the beginning of the journey, you shouldn't necessarily talk about what's the internal investment. I think you should look at if the idea fits your vision for the company, if it fits your innovation strategy, if it fits the direction in which you want the company to go, and then be like a VC, do metered funding. Ask the team, what can you provide me? What kind of evidence can you provide for me if I give you, let's say, $5,000? I'm not going to give you the 500 you asked for. I'm going to give you 5 because that's my appetite of risk. What can you do with 5,000 in 2 weeks? Can you do some interviews? Can you put together a landing page? Can you run a prototype? Can you run a series of interviews with clients? What can you do with $5,000 and 2 weeks? If the team comes back and says that's not enough, probably your teams are not, I would say, educated enough to use methodologies and processes like lean startup, design thinking, agile development, which again are promoters of short iterations and small steps in learning. Don't ask for an ROI early on because that's the best way to kill innovation. If you ask for somebody to provide you with an ROI day one, they just launched the idea yesterday, that's the best way to, first of all, demotivate them and to create a very poor culture internally, I would say, right? Because those estimations will never be reached, but you're creating a lot of expectation and a lot of frustration later on.
I think it also it results in something else, which is if the culture from the finance team who approved the budget requires proving ROI, that automatically filters out ideas and projects that can't prove ROI and only approves the sort of low risk incremental innovations
100%.
where you have the ability to have an educated guess as to what the future revenues might be.
Exactly. So basically it's pulling the company to only do incremental innovation, which leads to a risk of disruption later on.
Absolutely.
This is why we talk about, and this is why we talked about changing the entire organization, not just doing an innovation lab, because if you just do an innovation lab in your company, or you just do capability development, you obviously forget about all the other interconnected systems. I can go into a lab and I can teach everybody there the best thing around agile development, lean startup, design thinking, right? But those people will need at one point to interface with the people in finance, right? If those people are not trained to work in the same way, the entire thing collapses like a house of cards. Right? This is where we're talking about innovation ecosystems, and we're talking about changing an organization A to Z, not just the leadership, not just the culture, not just the process, not just the people. Everything needs to change if you're serious about surviving in this century.
So we've talked about innovation accounting that doesn't really work. Let's flip it on its head now. From the research that you've done and the sort of insights that you're coming up with around innovation accounting, what are the principles and KPIs, key performance indicators, that are actually more appropriate for innovative organizations and innovation projects?
I'll take one step back here and talk about what are the principles of a innovation accounting system, and then we can talk about some particular KPIs that fit this bill. And I will tell you why. Why? Because different layers of the organization require different KPIs for innovation. You cannot expect, for example, an executive to find useful the cost or the cost of learning or the learning velocity of a team. However, that executive might find very useful the cost of innovation in his company or in his department or his unit or his, whatever geography, right? They might find that information useful, but the cost of learning, not so much. So I'll take one step back and talk about the principles of creating an innovation accounting system, and then I can give you some examples of what I've seen working quite well. First of all, you need to have a company-wide agreed framework for innovation accounting, right? That's the first principle. It needs to be company-wide. Everybody needs to agree on it. And it starts with everybody agreeing on the definition of innovation. What does innovation mean for us? If you don't have a very clear definition in your company for innovation, forget about doing innovation strategy, forget about doing capability development in innovation, forget about anything that has to do with innovation if you haven't defined innovation, right? You can't work on something if you don't know what that thing means. Different companies have different interpretation, and it's normal because they are different internally and they work in different external environments. So everybody should start by creating their own definition of innovation. After that, you can create a company-wide framework for how do we measure that thing called innovation. The second principle, and this one is important, my background is in engineering, actually. So I'm an engineer by trade, electronics and telecommunications. So I've done my fair share of coding in my life, I would say. The second principle is actually a principle that comes from the IT world, and it's called abstraction. In abstraction, basically what's happening at an application level in a software or in an app, in a phone, is not something that your operating system needs to know in detail. However, the application needs to provide the operating system with certain bits of information that is going to help the operating system allocate resources to the app. Much in the same way, the abstraction system means that certain indicators within a team need to be communicated further up the chain of command, I would say, or further up the company for those people to be able to work on their own things. However, not everything that the team is doing needs to be reported to the chief innovation officer, to the CEO. But we need to be able to basically draw a red line between what the CEO sees and what the team is doing. That's the abstraction principle. One of the other principles is that innovation ecosystem improvements need to be enforced and informed by the innovation accounting system. If the innovation accounting system doesn't lead you to changing your innovation ecosystem, it doesn't lead to behavior change, it's not the right one for you. It needs to show also how the company is using certain assets, growth assets, what we call them, basically like processes, culture, and all these kind of things that can be used at one point for the growth of the company and can be used in the innovation process. And last but not least, the innovation accounting system should inform executives or investors or stakeholders in the disruption risk the company is finding itself under. So basically looking at the portfolio, looking at how company has performed innovation-wise, giving you a picture of, are we on the right track, or are we going to get disrupted, I don't know, in 6 months, 1 year, or whenever that cool new startup is lifting off. They are like the principles. I don't know if this kind of like answers. And I would actually like to hear your thoughts on this one. Just want to have a conversation here.
I mean, I think there's a lot to unpack there. I completely agree that the company needs a framework and a joint understanding of what innovation is and what it means to them. Because as you said, you need that in order to be able to set a strategy. And more than just some grand vision, the strategy needs to say the choices that you're making and therefore the choices that you're not making, so that the people making decisions around innovation can see whether or not they're actually moving in the right direction. And I think it's that concept of how do you measure if you're moving in the right direction and validating progress that's really more important around innovation than just showing that work is being done and being busy.
Yeah, 100%. One of the KPIs we usually encourage companies to use, especially at a team level, is learning velocity. How fast is a team learning? We're not encouraging them to push a team to a certain threshold or a certain, standard for speed of learning, because every industry is different, every company is different. But you need to measure that, because learning velocity is connected to cost of innovation, right? The faster you learn, the faster a product is launched in the market, hence cost of innovation is reduced.
And how do you calculate learning velocity? Are there, what metrics are you using?
So basically the metric is called learning velocity, and we're looking at, for example, how many learnings did a team produce in a certain interval of time, being a 2-week sprint or a 1-week interval or a month. You're looking at how many assumptions they have at the beginning of the time frame, and then how many learnings they produced at the end. You're not necessarily looking at the ratio, right? You've had 5 assumptions and now you develop 20 learnings. You're mainly looking at those 20 learnings. You're looking at if those learnings were deliberate learnings. Okay, so we set out with this question, this is what we learned. Or you're looking at they're not deliberate questions, right? Not deliberate learnings, sorry. What do you mean by that? I mean by that the fact that you might do an experiment targeted towards this question. However, in the process, you've uncovered all these other things. That's what one is the deliberate learning. The other one is the undeliberate learning, I would say. The other way to look at it, and also very useful, is look at how many experiments has a team performed in an interval of time. Again, 1 week, 2 weeks, a month, whatever. But you're not necessarily interested in a number, they performed 5 experiments, 20 experiments, because that can actually enforce a wrong behavior. But you're looking, first of all, did experiments happen? 1. And second of all, what was the ratio to learning? Experiments to learning, because if the team is just performing experiments and no learnings come out, you obviously need to train them to perform better experiments. If a team is performing 1 experiment and 20 learnings come out, that's a big question mark for a coach or for an innovation ecosystem manager, asking himself, what are they doing? Are they claiming everything is a learning? Are they gaming the system? Or are they performing multivariable experiments, which again is very dangerous? So what's happening there? Ideally, you're looking for a ratio of 1, right? 1 learning, 1 experiment. However, in my experience, I haven't seen that. Usually, it's about 1 experiment to every 2 or 3 learnings, or the other way around. So you get like 3 learnings out of every experiment you do.
And what about another KPI that you're a big fan of?
I'm obviously looking now taking it one layer up, looking at management level. We're looking at KPIs that have to do with the probability of success of a company, right? Probability of success versus risk, or divided by risk. Again, this requires a lot of training on the management side, right? How do we train a manager to look at the data provided by a team, and then be able to fairly well score the risk associated with that venture, right? Is it a 5% risk, 20% risk, 100% risk? In a lot of companies, we encourage the concept of creating a venture board where you have more managers sitting there and evaluating startups on an ongoing basis. Then you're looking at the cost of opportunity versus the cost of development. You're looking at certain KPIs are going to inform a venture board, or is going to inform a manager, or inform the decision of that manager, right? Should we invest in this startup, or should we invest in the other startup? Should we invest in this team or in the other team? This is at the management level. At top level, I'm usually looking at the cost of innovation. I like that KPI a lot. I'm looking at the dispersion of portfolio across the core adjacent transformation framework. How many things you have in transformation? What was the net economic profit of those versus the core, and so on and so forth. But again, as you can see, you can draw a line from what the team is doing and reporting on, all the way to how is our portfolio performing, and how is what's the cost of our innovation at the end of the day.
I mean, there's a lot to uncover there. Dan, it's been wonderful speaking with you.
If
people want to find out more about you and your work, and maybe the upcoming projects that you've got, what's the best place they can go to find out more?
Well, definitely they can reach out on LinkedIn. I'm pretty addicted to that platform, so you're gonna find me there pretty much every day. Twitter is also somewhere where I post, but if they want to learn more about our research and our work in innovation accounting, myself and Esther were constantly posting updates on our upcoming book, Innovation Accounting. They can just go to innovationaccountingbook.com, and they can see our latest blog post, our latest thoughts there, some videos. Maybe this podcast will be also published there. And in general, they can subscribe to our mailing list. They will get constant updates on our progress, and also bits and pieces of content.
Perfect. I'll make sure to get that link down in the description below. Dan, it's been wonderful speaking with you, and I look forward to speaking again with you soon.
Likewise, thank you.
Thank you so much for listening. If you liked it, please like, share, and subscribe, and leave me a comment about what you thought and what you'd like to see more about. If you want to take your creativity and innovation capabilities to the next level, then invest in yourself with the premium training only available at ideatovalue.com. These exclusive training modules have all been put together by me, Nick Skillicorn, and have been used by thousands of artists, innovation leaders, and CEOs to become better at understanding the source of their creativity and executing on their innovation ambitions. And there is no risk to you, as they are backed by our money-back guarantee. Now, don't forget to go out there and make your ideas a reality. See you again soon.